Hello and thanks for joining us at interest.co.nz. I'm Janae Tibbs-Urani and today my guest is top leader Geoff Simmons. Hello Geoff.
Kia ora, Janae.
Top has for some time now advocated for the introduction of a universal basic income. You're now suggesting that a debt jubilee be tied to this policy. Geoff, I just wanted to talk about what it is about this particular COVID environment we're in, and particularly what it is about what the Reserve Bank is doing with its monetary policy, its quantitative easing, that makes you believe that this is the right time to have a UBI and debt jubilee combo.
Well, first, I think we need to make it clear that concerns of hyperinflation are very much behind us. We're in an environment now, particularly with COVID, where the big concern is deflation, right? And I don't think I need to explain to your viewers what the risks of that are. You know, we really want to avoid deflation because people then delay spending in order to wait for prices to drop. So we definitely need to hit that positive inflation target of 2%. And the Reserve Bank is really struggling with the tools it has at the moment.
Okay, currently the Reserve Bank is doing quantitative easing. So basically it's committing to buying a whole heap of bonds from the market. The Reserve Bank has also really strongly signalled that next year it wants to cut the official cash rate into negative territory and introduce some sort of term lending facility for banks. Now the point of all of this is to keep interest rates low, at which point the hope is that households, businesses borrow more and spend, and also that people with debt, that having lower interest rates, that helps them service that debt. That is the current model we have. Now, Adrian Orr last week sort of acknowledged the fact that this does actually help people with assets the most, or it helps people who have debt. How concerned are you about this, Geoff?
Hugely. I mean, has QE actually been evaluated from when it's been trialled around the world, or are we just blindly importing this idea from overseas? You know, look, I have to preface this whole conversation, Janae, by saying I hope that some of these conversations are happening between the Treasury and the Reserve Bank, but you know, I don't get, there's no public indication of whether that is the case. But I seriously think that QE has failed overseas, so why would we want to import it here? I mean, the first count, it was supposed to be temporary. That was certainly the initial justification for it way back in the global financial crisis. It's never turned out to be temporary. As soon as they tried to start unwinding it, the markets freaked out and the Fed backed down. So I don't see that it's going to be temporary here either. And as you mentioned, Adrian Orr has freely admitted that the chief result of this is going to be to drive asset prices up. So we're relying on trickle down to stimulate our economy, which has all sorts of distributional impacts again, which I don't think have been discussed. Of course, there is talk of the Reserve Bank buying bonds directly off the Treasury. I mean, the only people that are winning from the current situation of the Reserve Bank buying bonds off the banks as an intermediary, it's just the banks win because they get to clip the ticket. Yeah. So I really can't see how QE can be seen as a useful tool.
Sure. So the issue, yes, at the moment is that the Reserve Bank has a mandate that's set in law to meet its inflation and employment targets. And the government says, look, Reserve Bank, we'll leave you to use the tools that you have to meet those targets, and we'll do our thing, and to keep that distinction. Now that in our system, whether it is a real distinction or just a perceived distinction, is something quite key to it. Geoff, if you manage to get into Parliament or join a governing party, how would you like the government to respond to what the Reserve Bank's doing? If we accept that the Reserve Bank's going to do what it's doing, how do you think the government should respond, particularly with a universal basic income and a debt jubilee duo?
Well, I mean, at the very least, the government needs to be getting behind the Reserve Bank and spending more in order to keep inflation moving. But what we will, what I think the question we have to ask is, have we reached the limits of that current monetary policy model that you just outlined? Have we reached the stage where actually that independence, that split between monetary and fiscal policy is past its use by date? I can't see any reason why we are using banks as an intermediary at the moment for government debt. Why can't the Reserve Bank just purchase it straight off the Treasury and effectively write it off, which is what modern monetary theory is suggesting? I mean, I guess the downside to this, as soon as we go down this particular route, is that it gives people like Winston Peters a blank checkbook. And while the idea of the government's household budget, myth might be, might not be real, it might not be a construct, it does at least hold, people like Winston to account in terms of, being able to splash cash around willy-nilly. So that then, raises the risks of being punished by foreign financial markets, all that sort of stuff. If it looks like we're heading down the route of a banana republic where there's no control on public spending. So what we need are we need to develop some institutions or some frameworks which can allow for this to happen in a considered, measured, and fair way.
Okay, so that is quite an important point. How do you do that? How do you say, look, we're going to expand our fiscal policy, have more government spending, write off that debt, but not turn into a banana republic? How does that accountability lie? Do you know how that would be done?
Well, the difference between conventional monetary theory and modern monetary theory is that conventional monetary theory says if we do what we're suggesting, then that will push up interest rates for the rest of the population. And of course, that would mean that the private sector is paying higher interest rates. So they would rightfully be a bit peeved if they saw the government, then throwing money around. What modern monetary theory says is that that's not necessarily the case, that the government can spend into the economy without raising interest rates for everyone else. So this is a key, theoretical issue which needs to be resolved. And I think it can only be resolved through empiric, experimentation, which is what I'm really talking about here.
Yeah. Okay, Geoff, I'm just going to stop you there. Empiric experimentation. People are going to think this is not the time for experimentation. Right? I mean,
well, but we need. Oh, I absolutely think it is the time. We have reached the limits of the usefulness of current monetary policy.
How do you think the universal basic income would be helpful at the moment?
Well, I guess what I'm suggesting is if the Reserve Bank were to create money, it could do QE for the people, in which case it just gives that to everyone equally as a form of, you could call it a UBI, you could call it helicopter money, whatever you want to call it. But we give that, you can trial this, we can try giving smaller regular amounts and see how it goes in terms of stimulating the economy and what impact that has on the reaction of foreign markets. And that way everyone gets equal benefit from this particular money creation process.
Sure. Okay, you've suggested something in the realm of $250 a week for 6 months. And if you give that to the working age population, the cost of that is roughly $20 billion. Now, to put that in context, the government spent about $14 billion on the wage subsidy. I mean, $20 billion for 6 months of stimulus is a lot of money, isn't it?
It is. But, we're in a situation where the Reserve Bank is talking about creating $100 billion with which to buy government bonds. So, in the context of that, it doesn't look so great. And when you look at the distributional impacts of that money that is being created, as you've already set out, most of the benefit of that is going to go to asset owners. So again, I think that should be raising a red flag in terms of a society which already has big problems with inequality, and we have already got problems with a housing bubble. And I think we can totally expect that most of this money is going to go straight into housing, because it's favoured by banks as a more stable asset class, and of course it's favoured by the tax system as well.
Now, this debt jubilee part, you're suggesting that if someone has debt, then the UBI will have to go to repaying the debt first. Is that correct?
Yeah, so the idea of a debt jubilee is that you write off people's debt. And the big problem with a debt jubilee is that the big advantage of it, of course, is that it allows a reset within the banking system, because we rely on debt to create our money and therefore as an engine of growth. Over time, as that debt accumulates, it becomes too much the repayment burden becomes too much for the economy, and it acts as a brake. And I think that we are seeing that right now as an impact. So a debt jubilee allows a bit of a reset, allows that debt to be taken down and written off, so that it frees up resources in the economy for us to grow again. The downside of a debt jubilee is that it favours people with debt, because you're only writing off debt. So what I'm saying is, why don't we have a UBI which, the people that don't have debt can get the money, and the people that do have debt have it written off instead of receiving the UBI.
I've just looked at the Reserve Bank's household balance sheet, and housing and consumer loans are worth around $223 billion. Now, if you're pumping in about 20 billion, and some of that will be used to pay off this debt, what's to say that won't just pay off the debt, and then our whole system will just kick on in terms of building up more and more debt, people buying houses, taking up debt, buying more houses, and on it goes. How would this be a systemic change? Would it even be systemic change? Would it just be writing off some debt and then getting straight back to the same old system?
Well, it allows as a reset to give people within the system a bit of breathing room. And I think in an uncertain time like this, I doubt that we will see debt levels bounce back to where they were previously. I think over time they will bounce back to where they were previously, of course. And that's why ancient civilizations in the past had regular debt jubilees. They had these sorts of things to constantly allow a reset within the system, because there is always going to be that pressure to build up debt. But I think under the current environment, I doubt that would be the case very much. I think people will be quite happy to see their debts taken down in a period of uncertainty. And the big advantage of that, of course, is that it takes out, because debt is the way that money is created in our financial system at the moment. If a big chunk of that money created by the Reserve Bank is then going into effectively destroying money by destroying debt within the banking system, then it has a relatively neutral impact on the money supply. Of course, there will be some positive impact on the money supply, because not everyone is going to have the debt, so they will be getting some of the money. But I think that is very much needed in the current situation. Okay.
Geoff Simmons, thank you for your time. There's a lot to think about there. And I'm Janae Tironi from interest.co.nz.